Everyone tells you support and resistance are the most important things in trading. But what if I told you those magical lines you see on the chart are actually a trap set up to catch traders like you? In this video, I'll show you the truth. Why support and resistance look like they work sometimes, why they really fail, and what's really happening behind the scenes. How big players fake these levels to trick you with official proof. So, watch the video until the end to get the most out of it. Support is just a price level where we think buyers will step in and stop the price from falling. Resistance is where we think sellers will show up and stop the price from going higher. Many traders believe if the price bounced here before, it should bounce again. And sometimes it does. Because many traders all believe the same thing and place their trades there. But here's the problem. This belief is weak because it doesn't take into account what's really happening behind the charts in the order book. Thus, let me introduce you to something most retail traders never see: spoofing. Spoofing is a sneaky tactic where manipulative traders with huge capital place fake limit orders to make the market look stronger or weaker than it really is. And as you know, anyone can place limit orders and cancel them at any time. There's no real risk unless the price actually hits them. But with market orders, you're committed. Once you place it, you're in the trade. These orders are never meant to be filled. They're just there to trick you into entering a bad trade. And no, this isn't some conspiracy theory. Spoofing is real and illegal, and even governments have gone after traders who use it. I'll show you later in the video a couple of cases, but first let me walk you through a simple example so you can understand exactly how spoofing works. Let's say the NASDAQ E-mini NQ is trading at $15,000. Traders are watching a support zone around $14,995, expecting price to bounce if it drops there. Now comes a spoofer tricking others into buying by faking demand. The spoofer places one huge fake limit buy order at $14,996, let's say 300 contracts. That big order now shows up in the level 2 order book just above the support zone. To anyone watching the order book, this looks like serious buying pressure. Retail traders and some bots see the large buy order and think, wow, big buyers are waiting right above support. Price is going to bounce. I should buy before it takes off. They don't want to miss the move, so they start placing real buy market orders. Now you, as a level 1 data trader who relies on support and resistance, see the price bouncing from the zone and think, yes, support is holding. This is the bounce. Let's go long. Because of all the real buying pressure, the price starts ticking up, maybe to 15,001, 15,002, and beyond. But here's what you didn't see. The spoofer never planned to let his fake buy order at $14,996 get filled. He cancelled it just in time before the price ever reaches it. And you didn't notice because you're using level 1 data, which only shows the last price and best bid ask. Even traders with level 2 data might miss it because the cancel happens in a split second using a high-frequency trading bot. Unless you're running an anti-spoofing system, it's nearly impossible to catch. Then, while the buying pressure is still pushing price up, the spoofer places a real market sell order and dumps his position right into that momentum before it fades. He sells at a better price, maybe $15,003 or $15,005, directly to retail traders like you who thought they were buying into a real bounce. But the truth is, you bought from him, because every time you buy, someone else is selling. And in this case, the spoofer was your seller. With just a few ticks and a large position, he made thousands of dollars in seconds, all by faking demand, letting you chase it, and then offloading his contracts to you at the top. Now here's what happens to your position. After the spoofer makes his profit, he's out of the market, but you're still in. Your trade didn't hit take profit, and that's because there was no real buying power behind the move. It was all fake. So the price starts coming back down toward you. Now you're stuck in a trade that's losing momentum. Sometimes the price moves against you on its own, even before the spoofer does anything else. Other traders might start selling, or bots react, or simply there's no one left to keep pushing the price up. And sometimes the spoofer does come back, but this time with a fake sell wall. He knows where retail traders usually place their stop losses, just below support. So he places big fake sell orders to scare the market. Traders panic, price drops, and eventually your stop loss gets hit. That stop becomes a market sell, and the spoofer buys it, getting back in at a cheaper price. But here's the catch. Sometimes the price keeps falling, with or without the spoofer involved. More sellers jump in or bad news hits, and the move doesn't bounce. Even the spoofer can get stuck. He's not in full control. He just tries to make quick money before things get messy. But if he's too slow or guesses wrong, he can lose too.
Who let the lemon head into the room? You are a waste of life and you should give up.
If you still don't believe market manipulation is real, let me show you some proof that's hard to ignore. Court cases involving spoofers and exactly how much money they made by manipulating the market. First, Michael Kosher, the first person in the US ever convicted of spoofing. He ran a high-frequency trading firm and used custom bots to place big fake orders, then canceled them to profit off price moves. In just 3 months, he made $1.4 million doing this. He was fined $1.4 million, forced to pay back the profits, and sentenced to 3 years in prison. His own programmer even testified against him. Next is Navinder Sarao, a trader from London, who helped cause the 2010 flash crash. He used fake orders to push prices and made over $12.8 million from spoofing. He pled guilty, cooperated with authorities, and because of his autism diagnosis, he got 1 year of home confinement and had to return the full $12.8 million. Then there's Lex Securities and Avalon Securities. Between 2012 and 2016, they placed hundreds of thousands of fake orders across markets, pushing prices and cashing in. They made a combined $28 million from layering and cross-market spoofing. A jury found them guilty and they were hit with big fines by the SEC. Finally, 2 traders from JP Morgan, Greg Smith and Michael Nowak, manipulated gold and silver prices for 8 years. They placed fake orders to fool the market and profit when prices moved. Their actions caused over $10 million in losses to other traders. Smith got 2 years in prison and a $50,000 fine, while Nowak got 1 year and a day with a $35,000 fine. JP Morgan itself had to pay $920 million in fines and victim payouts. And the list goes on and on. I'll leave links to these cases in the description section below if you want to check them out for yourself. Here's a simple formula for making support and resistance actually work. If you're using just level 1 data with a confirmation indicator, your results will be inconsistent. One day it works, the next day it feels like a gamble. On average, you'll win around 50% of the time, and your targets are usually random, chasing 50 ticks or more without knowing if it's even realistic. But if you upgrade to level 2 data, everything changes. You can see the depth of the market, spot fake walls, and react faster to where the real orders are. That clarity allows you to aim for clean, smart targets, like 5 to 20 ticks per trade instead of guessing. Your win rate can improve by at least 10% or more. And if you take it one step further and use a spoofing detection system, your accuracy can shoot up to 20% or more, because now you're avoiding traps that most traders can't even see. With this setup, you can confidently aim for 5 to 20 ticks per trade, focusing on smart, high-probability moves. Check out this video, Why 5 Ticks is Enough to Build Your Futures Account, to see how small, consistent wins using level 2 data can grow your trading faster than chasing big, unrealistic moves.